Hey everyone, in today's video, we're going to be talking about how you can lower your healthcare costs in retirement with Roth conversions. I find talking with retirees that healthcare costs are one of the major hot button issues for retirees, and understandably so. Well, in today's video, I'm going to show an example later how a specific couple can save over $1,000 a month in healthcare premiums through Roth conversion strategies. So stay tuned. If this is your first time on our Safeguard Wealth Management YouTube channel, make sure you go ahead and hit the subscribe button, be notified of all future videos that we release just like this. Also, if you like this video, make sure you hit the like button down below. Okay, let's get into it. So we're going to be talking today how to earn a Affordable Care Act insurance subsidy with Roth conversions. So this is part of our series where we're talking about specific tax hurdles that Roth conversions can help you overcome. And so as we talk through today's video, this is specifically for those retirees that are retiring before age 65. Well, why age 65? Well, once you turn 65, most of you will go on to Medicare. Okay, so we're talking about Affordable Care Act insurance. Let's say you retire at 62. Okay, you're going to have a couple of different options for healthcare options. A great option I recommend everybody explore to some extent is the Affordable Care Act insurance. Okay, so we're going to be focusing on Affordable Care Act insurance in today's video here. And so there are two essentially regimes that we need to plan under for the Affordable Care Act. Okay, as part of the third COVID stimulus package, the American Rescue Plan was passed. Okay, and it changed some Affordable Care Act insurance rules for years 2021 and 2022. Okay, prior to the American Rescue Plan, there was something called the subsidy cliff. Okay, so prior to and after this American Rescue Plan, we will go back to planning under the subsidy cliff. So I'm going to talk about both of these different planning regimes and talk about why Roth conversion will make sense in each of these regimes, okay? First, though, we're going to be focusing on this subsidy cliff. So again, for those retirees that will be retiring before 65 and will be retiring or will be on Affordable Care Act insurance from 2023 and beyond, okay, this is going to apply to you, and this makes Roth conversions especially powerful. Okay, critical takeaway before we get into this. Oftentimes, when we have people assessing whether a Roth conversion makes sense today or sometime in the future, they focus on just the tax rate. Okay, meaning you might be in the 22% tax bracket right now, trying to assess whether a Roth conversion makes sense. What I would urge you to include in addition to the tax rate is something that we call the expense rate. Okay, so for instance, let's say earning more income causes you to lose a healthcare subsidy. Well, you should include that loss of that healthcare subsidy as part of your tax rate, because by reporting a higher income, you are losing a benefit. Well, that loss of a benefit is an extra expense that you should be assessing or including as we assess Roth conversions going forward into the future, okay? So let's talk about how to qualify for a subsidy under the Affordable Care Act insurance. So two things will determine if you qualify for a subsidy. Something called household size, meaning for most retirees, you're either going to be a single filer or a married filing jointly. So your household size is likely going to be one or two people. If you have a special needs child, you may have an additional third person or fourth person in your household size. But for the majority of you, it'll be one or two for a household size. And then you also have to look at your modified adjusted gross income. Okay, so we're going to often refer to this as your reported income for healthcare. And we'll talk about everything that's included in that. But essentially, if you're under the 4% of the federal poverty level, you will qualify for a subsidy. So in 2021, for a married couple, this would be $68,960. Okay, so try to keep that number in your head. So what is all included as part of this healthcare modified adjusted gross income? Okay, there's all these different tax terms. Healthcare modified adjusted gross income is somewhat of a confusing term because it includes more than some other tax terms. For instance, it's going to include wages and distribution. So if you pull money from your IRAs, that's included dollar for dollar. Then it also includes all untaxed Social Security benefit, taxed and untaxed. Okay, so let's say you're taking $30,000 from Social Security, but only half of it is taxed. Well, guess what? That full $30,000 is included in this number. Okay, then pension and annuity income, capital gains, any passive income like rental income, unemployment benefits, as well as any interest generated from a checking or savings account or a CD. Okay, what's important to note is what's not included in this healthcare modified adjusted gross income. The main thing are Roth withdrawals. Okay, so if you pulled $100,000 from a Roth IRA in a given year, guess what? That's not included as healthcare modified adjusted gross income. You would have a zero for healthcare modified adjusted gross income if that's all you pulled for your income. Okay. Now, a very important distinction that often confuses people. Your taxable income, many of us are familiar with taxable income. This includes all of the deductions, including your standard deduction. Okay, well, guess what? Healthcare modified adjusted gross income is a number that does not take out your standard deduction. So let's say you have a taxable income of $50,000. Your modified adjusted gross income, if you're married, might be something like $75,100. Okay, so your healthcare modified adjusted gross income will always be higher than your taxable income. Okay, and so planning under this healthcare subsidy cliff regime that we'll see from 2023 and beyond is a tough thing to plan around, and it's important to know essentially where your liabilities are within this regime. Okay, so basically, as you start from the first poverty level all the way up to the 400% poverty level, your costs will increase fairly linearly, meaning that as you take money from your IRAs through this certain range right here, again, you're going to see your costs rise linearly. You're going to lose a subsidy linearly. So if you take $100 from your traditional IRA, you might lose something like 8% of your subsidy or something like that, or $8 of that subsidy, 8% of that $100 withdrawal. Okay, but you're going to hit a certain point where if you make a few dollars more than the 400% poverty level, you see a cliff here, where essentially you lose a significant subsidy in a very narrow range from reporting higher income. Okay, and so it creates a cliff where you might take an extra $1,000 from your assets, and you might lose a $500 a month subsidy or something along those lines. Okay, so conceptually, we can see how this healthcare subsidy cliff is created. We want to fall somewhere in this zone right here. Obviously, we don't want to fall over on this side of the cliff because we basically lose our subsidy altogether. Okay, so let's go through an example, and hopefully this will come alive and show just how powerful Roth conversions can be in this given scenario. So let's say we have a couple here. They're both 63, and they're planning on retiring in 2023. So they're going to be subject to this subsidy cliff from 63 to 65. They're going to need Affordable Care Act insurance. Okay, so while they're currently working right now, their taxable income is at $110,000. Okay, so they're currently in the they're currently in the 22% marginal bracket. Okay, their retirement income need is $70,000, and they have a Roth balance of $10,000. So I show that they have a very small Roth balance, so they're really not going to be able to use their Roth assets over these 2 years in order to save on healthcare costs, because they basically don't really have a significant Roth balance. And so we're going to look at an Obamacare Silver plan, Affordable Care Act, Obamacare. They're the same thing. Again, just a different term for classifying this program. They're on the Obamacare Silver plan. And so if they show a modified adjusted gross income higher than $70,000, they're going to have $1,905 per month in insurance costs. Okay, if they can show a modified adjusted gross income of $20,000, look what happens to their healthcare costs. They earn a massive subsidy, almost $1,800 a month in a subsidy, and they see their premium costs fall to $110 a month. And so we see there is a huge gap between these two healthcare plans based on how much they report for income. And so again, they're in a situation right now where most people would squawk at performing any Roth conversion. After all, they're in the 22% bracket. They're going to be in a lower tax bracket in retirement, we see. But again, we have to include not only taxes, but also their expenses. Notice they're going to have some significant expenses over here based on how much they report for income. Okay, so let's look at this. Let's say they're taking $70,000 of modified adjusted gross income, meaning they're probably pulling all of that income that they need from traditional IRAs. Okay, so all of it is taxable. All of it is included dollar for dollar as modified adjusted gross income. So they're going to owe $1,905 per month. Well, taxes, again, we're not including state taxes here because I'm sure all of you are in a different state which has a different tax liability. Federal income taxes, they're going to owe about $5,000 in taxes. Based on this $70,000 of income that they're pulling, that's about 7.14% as an effective tax rate. And so many would just look at this and go, why would I convert at 22% when in retirement I'm going to be at a 7% effective tax rate? Well, again, don't just look at the tax rate, look at the expense rate as well. So when we include expenses on top of this tax rate, meaning all of the healthcare premiums they're going to have from reporting a higher income, notice their expenses rise to $27,860, which on $70,000 of income is essentially a 40% effective expense rate. Okay, and so now converting at 22% in order to avoid having an expense rate of 40% makes a ton of sense. Okay, and so let's say they were at $20,000 of modified adjusted gross income. Again, we see their significantly lower healthcare costs here. They'd be under the standard deduction, so their tax rate would be 0%, and their expense rate would be $1,320 because we have to essentially annualize these healthcare premiums. Now, this number, as I'm seeing right now, would not be right because we'd be looking at their effective expense rate on the full $70,000 because essentially to have a reported income of $20,000, they still need to take the same retirement income. What this means essentially though is they'd be taking $20,000 from IRA assets and then they'd be pulling the rest from something like Roth assets. Well, again, the problem is they don't have enough in Roth assets right now. Well, they have 2 years till retirement. So wouldn't it make sense? Again, so they're at $110,000 of taxable income. So they're in this bracket right here. Okay, and they have up to the $172,000 limit essentially in order to fill this 22% bracket without jumping into the next bracket. Okay, so wouldn't it make sense for them to convert, even though they're at 22% and it looks like they're going to be at a lower tax rate in retirement? We should be looking at the expense rate. So wouldn't it make more sense to convert at 22%, fill up, max this bracket, increase the amount they have in Roth assets so they can pull from those Roth assets in order to earn a subsidy? So convert at 22%, create enough income where they can, rather than showing a $70,000 modified adjusted gross income, they can show a $20,000 modified adjusted gross income. They'll see that $1,800 a month almost in expenses completely eliminated, and they'll save far more, again, because of they're thinking about expense rate, not just the tax rate. Okay, and so this is a perfect example to show how a very intentional Roth conversion, even while they're still working, can translate to them saving significantly on healthcare costs. And again, I find healthcare costs are one of the biggest worries, biggest hot button issues for retirees, and understandably so. There is a huge gap between reporting $70,000 of modified adjusted gross income and reporting $20,000 of modified adjusted gross income. Okay, so let's talk about the American Rescue Plan. So essentially the healthcare planning regime we have for the next 2 years. Excuse me. Okay, so we see here in blue this old healthcare subsidy cliff. Okay, this subsidy cliff is coming back in 2023 unless there's another change by Congress. And notice we can see what happens here. As this person takes more income, they're going to see a cliff where they're going to lose a huge percentage of their subsidy by just taking an extra couple or reporting a couple extra $1,000 of income. Well, the American Rescue Plan essentially smoothed out this subsidy cliff. So now, once you hit over the 400% poverty level, your essentially costs still increase linearly. Okay, for somebody at the 400% poverty level or going over the 400% poverty level, they will see their costs essentially increase by 8.5% for every dollar they take in extra reported income. So over this 400% poverty level, essentially, if they take $100 extra and report an extra $100 in reportable income, they're going to owe an extra $8.50 in healthcare costs because they're losing $8.50 essentially of that healthcare subsidy. Okay, so planning for Roth conversions under this American Rescue Plan regime, what I would urge you to do is just include the extra expense ratio here as an extra tax. So essentially for every dollar that you pull, you're going to be owing an extra 8.5% as an expense ratio. Okay, so if you're in the 22% bracket pulling an extra dollar, you're actually going to be somewhere in the 30% range because of that extra 8.5%, if that makes sense. 30.5% you'd be at that point. Okay, so again, Roth conversions can still make sense given this scenario. Okay, if we add in this extra expense ratio and we're paying less in taxes today in order to convert, in order to earn a subsidy later, again, that can make a lot of sense as well. And so, again, after showing this type of video, we're going to get the question, how much should you convert in a given year then to earn a healthcare subsidy? And again, big asterisk here, it depends on your situation. Okay, you want to basically convert enough so that your expense ratio in the future is going to be lower than you could convert today. Okay, anytime you can convert at less than your expense ratio will be in the future, you want to convert in order to save that. Okay, Now, that being said, it doesn't mean you want to convert significantly more than you need, because you're basically trying to convert in order to avoid paying that expense ratio. So it wouldn't make sense, given this previous example here, it wouldn't make sense for this couple to convert somewhere in the 32% range, because they only need essentially Roth money for those next 2 years, or I should say the first 2 years of retirement in 2023 and 2024. So they essentially want to convert enough where they can control their reported income at $20,000 rather than reporting it at $70,000. And so again, it's going to depend widely based on your situation how much you should convert in order to earn a healthcare subsidy, in order to decrease your healthcare premiums. It's going to change for everybody, so it's very difficult to give a very broad answer on this topic. It's important to note as well, they might be in a situation where they might not want to convert the full $50,000 in a given year. In fact, we're showing an extreme example of a reported income of $20,000 versus $70,000. They might be in a situation where it makes more sense to show a reportable income of something like $40,000. So that would mean only a $30,000 conversion in order to save on costs. Because remember, costs will rise linearly to an extent, and then we'll see the cliff. So our big message here is you want to avoid the cliff. You may still want to take some certain extra healthcare expenses from $20,000 to $40,000 of reportable income, if that makes sense. Okay, and so this is a layered discussion talking about how much you should convert in a given year. There are as well alternatives to a Roth conversion in order to earn a subsidy. Okay, let's say this person, that previous person, had $200,000 in cash reserves. Well, they've already paid taxes on those cash reserves, so they could use those cash reserves, money in a checking account, in order to essentially replace their income. So rather than taking $50,000 from their Roth assets, they could take it from cash reserves and essentially have the same modified adjusted gross income. Okay, a brokerage or taxable account can also be used. Let's say you have a $200,000 account with $150,000 of cost basis. Well, if you sell, let's say, $100 worth of stock in order to take that as income, your cost basis is $75. So only $25 of that $100 is going to be included as reported income. So a taxable account, a brokerage account, could be a great way to still have some reported income, but report far less than taking from an IRA would be. Downsizing of a home. Let's say that right before retirement, you're going to sell your home and buy a home that's half the price. Well, the proceeds from selling that first house, those can be used just like cash reserves in order to earn a subsidy. Debt or a HELOC, okay, if you have a home equity loan, that can be used. You can take money essentially from your house, earn that subsidy, and then pay that money back with traditional IRA assets as soon as you're not under this Affordable Care Act constraints, as well as healthcare savings account receipts as well. So there's a strategy. We're going to be releasing a video here in a little bit that talks through this strategy, but essentially there is no limit on when you can recoup receipts from an HSA. You just have to have started the HSA and be incurring costs after that first HSA is started. So for instance, let's say that you started an HSA 10 years ago, okay, and you've been paying healthcare costs out of pocket, but you've been keeping those receipts. And so let's say that you've accumulated $50,000 in healthcare receipts over the last 10 years, but you've been paying that all out of pocket. Well, now early in retirement, you can take those receipts, essentially take money out of your HSA. You already have those receipts, so you can take that $50,000 out of your HSA essentially completely tax-free. But again, we'll talk about that in another video. After that video is up, I'll link to that video as well. It'll be up in the right-hand corner of this video. So the big message here is that with intentional strategic Roth conversions, you can save significantly on healthcare costs under the Affordable Care Act insurance regime, essentially, okay? And so in this example, we showed that they could save $1,800 a month almost in extra in healthcare premiums just by earning a subsidy by strategically using Roth conversions. So this is a great example that shows you don't need more money, you need a better plan. Okay, you need a well-built Roth conversion strategy that can help you save on healthcare premiums early in retirement and also later in retirement. We'll be recording additional videos on other tax hurdles that you can use, or that other tax hurdles that where you can use a Roth conversion strategy in order to avoid those tax hurdles. Okay, so again, if you like this video, make sure you hit the subscribe button, be notified of all future videos. We release videos each and every week. Always remember, you don't need more money, you need a better plan. Thanks for watching. Leave any questions or comments in the comments below. Have a great rest of the day.